Hello and welcome to New Future. A while ago I released a video called Watch This Before You Invest in the Stock Market. It was an introductory video where I start talking about the stock market and what you need to consider before you actually start creating an investment plan for yourself. I'm now going to make a follow-up video on this, and in this video specifically we're going to be focusing on coming up with your investment strategy. And before I begin, remember that this is for entertainment purposes only and that this is not financial advice. Always make sure you get professional advice before you make any financial decisions. With that said, let's begin. So if you watch that video, you will see that I listed 3 different examples of investment strategies. In this video, I'm actually going to talk about 4 different investment strategies and things you need to consider when coming up with a specific strategy for yourself. And it's going to be different for everyone. So you really just have to think about what fits you best, what you're trying to get out of the stock market, and whereabouts you want to put your money within the stock market. All of these different points will affect what you choose when you're investing in the stock market. So just like in that other video, we're going to talk about different investment strategies. The first one is dividend investing, the second one is dividend growth investing, and the third one is growth investing. And I'm also going to add in a fourth one, and that is trading, day trading. And if you don't know what it is, don't worry, I'll tell you soon. But they're all different in their own rights for different people who have different approaches to their money, different tolerances to their risk, and all of these different factors are involved. So let's start with dividend investing. This can be very popular, especially for those who have a large amount of money and those who are looking to retire. And that's for a very specific reason. If you don't know what dividend investing is, it is effectively where you're buying shares in companies that specifically have a high dividend. So what are dividends? Dividends is what the company that you've bought the shares for will actually give the shareholders a part of their profits. So let's say company X made $100 million in clean profit. Then it might say half of this we're actually going to give to our shareholders. You normally wouldn't want to buy a company that gives all of their money away, because what that means is that they're not actually reinvesting the money to grow the business even further. You want to buy shares in a business that is actually looking towards the future and looking for growth. However, the main focus, at least for this one, is focusing on that dividend. And so how do you find a dividend? Well, it's quite easy, and I'll show you exactly how to do it. If we go to Google, let's look at Apple as an example, and we want to look at their stock. Let's just type in Apple stock and it'll come up right here. Now this might look familiar if you've been involved in the stock market. It'll show you what the shares are doing at any set time. But what we actually want to look at is this yield here. And this can be very misleading and very confusing if you don't understand how this yield works. So this yield is a calculation. It's not a set amount. It's not like Apple said, hey, I want to give out 0.53% as a dividend. It doesn't work like that. It's a calculation. To explain this better, let me show you. Now what we can see here is a dividend per share. And what this amount is a quarterly dividend, where Apple has decided for every share that someone owns, we're going to give out 22 cents. But why is that important? Well, you see, the dividend calculation here is just maths. It's what the percentage of the yield on the shares at the time of purchase. That's why when you buy the shares low, you're effectively locking in the annual dividend yield at the time of purchase. So this could mean, let's say, Apple had a terrible quarter. Everyone one day woke up and decided, we don't want Apple products anymore. And this dropped all the way down to $10. Well, then this amount will get recalculated to that $10, and this will be much higher percentage than it is right now. So when you look at this percent, you need to consider where it is at the market at the time and whether the price of the shares is going up or down, because this number isn't so important than what this number is. And this number here also isn't as important as the amount of shares you own. For example, if you own one share, you will get 22 cents per that share every quarter. So what this means, in order to get that passive income coming to you, you need to think about how many shares you want, or how many of the 22 cents do you want. And this number here isn't as important. Hopefully that makes a bit more sense, because it can be very confusing when you just simply see this number. During the pandemic, you saw a lot of people actually buying a lot of shares simply because the prices were so low. And the lower the price, the more shares you can buy, which means the more 22 cents in this example you could buy. But buying when the shares are down, as long as there's nothing wrong with the business and you don't think the dividend will go down over time, is a good thing. Just remember that you want to look at their track record. For example, here's Apple, but let's change it to an Australian share, Wesfarmers, and it has a pretty good yield for what it is. You normally find the ones that have high dividend yields, they're usually boring companies. And I don't mean the Elon Musk boring company. I mean they're actually pretty boring. They're usually involved with food. They're usually involved with real estate. But we'll talk about the real estate one coming up soon, because they work slightly different. And it's good to understand that. What we're looking at here though is we're seeing good growth. Obviously things are going down. The market's going down in general, and we're quite low at the moment, as we can see from its highs. But I think this will bounce back. Once everyone gets more confidence in the market, things start to bounce back. Hopefully the supply issues all get sorted out and we don't have a recession. Things should get back to normal. But again, we're looking at a 3.38% yield. That's pretty good. So you want to try and find a yield that is probably around anywhere between 3 and 5%. Anything around there, then we're fitting perfectly into this new type of investing, this dividend growth investing. This is where they both have good growth on the yield and the company overall. For example, if I go here and we look at Apple's here, we can see that they've been pretty consistent there for a while. Things are a bit higher here, but that's because there was a stock split. For every one stock, they split it 7 ways. So obviously this number will drop. Now, in this example, we can actually see that they were quite higher than they are now. It's been split into 4 times. That means that the price is just about right. If you look at any other company and the amounts are all over the place and there's no reason for it, unlike where we see there's a stock split here, then be worried. In this case, this is good growth. They've gone from 82 and then 1/4 of that went to 0.205 and now they're at 22 cents. Seeing that growth is really good to see. And this is probably a perfect example to see how that has grown over time. However, this is a very low dividend yield. So Apple, if you are purely buying it for dividends, is not the best pick. You're looking at the dividend. You want to see that passive income come in. However, you also want to see good growth for that company. And this is a good example. If we look from Feb 2017 to its highs, that's gone up. That's doubled your money. If you've doubled your money in 5 years, you shouldn't be complaining too bad. That's pretty much on par with if you invest in real estate in a really good area. That's pretty good growth. Obviously, again, we said it has dropped, so it's important to remember that. I think that's less to do with the company itself. It's more to do with the situation that the markets are in at the moment. So to recap this, you're looking at companies that have good growth and they're having a good dividend yield. Usually dividend yield givers are boring, well-established companies, but in this example, we want to try and find ones that have good growth. And Wesfarmers, which they own a bunch of retail companies, and we're seeing good growth in those sectors. And as long as you're looking at those 2 factors, you're seeing good growth over time and you're seeing good dividend, then you're falling within that dividend growth area. Personally, this is where I land. It's nice to see my money work harder for me, and it's creating that dividend yield. So it's like if you own real estate, your price of the real estate is going up over time, and you're also getting as a benefit to help you pay off that mortgage, you're getting that rental income. A dividend yield is effectively your rental income. It's the company's way of paying you for the money that you put into that company. As I said, you want to try and keep your dividend with either of those two, dividend or dividend growth investing. You want to keep that somewhere between 3 to 5 because you don't want this too high. And the reason I say this is you want to see them reinvesting some of this money, and you don't want them to pay too much, because if they pay too much, that can show some warning signs. And how do we do that? If I go to this website, we can have a better look here to explain exactly what a payout ratio is. The dividend payout ratio here is 14%. That is really small. That's the amount of profits that they're giving away. So if I type in here A and Z, because banks come up pretty high with their payout ratio, if I type that in, we can have a look here. As we can see here, there's a little bit of description here. This payout ratio is healthy, sustainable level below 75%. It's important to keep it lower than this. If they're giving out, let's say 80 or even 90%, then that's not a good place to be. You want to make sure that they're actually reinvesting some of that money so they can continue to grow. So especially with dividend growth investing, having that money reinvested so the company can keep growing is a good thing, because what that means is over time that dividend will get increased. So before we get onto growth investing, we need to look at one thing: real estate investment trust. These are real estate companies that do one thing: they buy up real estate. They own this real estate, and in turn you own the real estate that they're buying. And since basically that's all they do, REITs will usually have much higher dividend yields. As we can see here, Stockland Corporation, their dividend yield at the moment is 6%. And in turn, you'll also see that their payout ratio is a lot higher. As we can read here a little bit more about Stockland, we can see it says Stockland has a very high 3-year median payout ratio of 68%, implying that it only retains 32% of its profits. However, this is not unusual to see REITs with such high payout ratios due to the statutory requirements. And so what this basically means is that they have to, by law, give out quite a bit of the money that they earn. And so pretty much all REITs, you'll see they have high payout ratios. So with that said, let's move on to growth investing. Now this is where we start to get into that tech sector. And let's look at some booming stocks, some booming tech stocks. Especially in Australia, we're seeing the fintech stocks, the finance tech stocks. Unfortunately, just like everywhere else in the world, all of these tech stocks are going down. Let's look at Zip, which is an Australian fintech company, as I said. If you bought it in 2017 and held on to it until its high in 2021, you can see that it is up 1,568.92%, which means you will be very rich right now if you bought at the low and then sold at that higher price. Here's one of the issues with growth investing though, is that we've got this massive drop off and it is down quite a lot. So if we look at from the beginning to now, it is still up 220%. However, that is nothing compared to its very high peak. So you're not worrying about the dividend at all. You really only want to look at that growth. You're looking at companies that have a lot of hype around them and they really look like they're going to have a good future. And then that leaves one last type of investing. And I say that with a caveat. It's really not investing at all if you look at what the Australian Tax Office has to say about it. And that is trading, day trading. So you're either an investor or you're a trader. And the trading is effectively, you're going to buy shares at the beginning of the day, and by the end of the day, you're hoping those shares have gone up in price. Let's say you heard a really big announcement and you think they're going to make lots of money very quickly because of this news, and hope that by the end of that day, it has gone up in price as high as possible. But let's say it went up 2%. You put $1,000 in, it went up 2%, then you will sell it and you will gain the 2% difference. Obviously, if you're doing this, you're hoping that it could go up to 10%, 20%, even 50% if it's really good news, and you've just made a lot of money. But why is this not investing? Well, you're not putting your money away for the future. And this has a few caveats to consider. So the first one is, okay, so maybe you might be able to make some money, but you could easily lose it. That's part of the problem with, if you keep looking at the shares, if I go and look at Qantas here at 5 days, we can see it's up and down all over the place. With the other two, what you're doing is you want to see this go up over time. Trading is a lot more involved and you've got a lot more risk. But one of the main benefits of actually investing over the long term is the way the Australian tax works. So if you are in Australia, the way that it works is that if you're going to buy and sell in a period under a year, you're known as a trader. You buying shares and selling shares is seen as a job. It is seen as income. If you hold on to it for 3 years, 5 years, any amount effectively over a year, that is known as capital gain. And simply by looking at this description here, which is taken from money.com.au, here is one of the main reasons why I personally wouldn't do day trading. That is because if we read this sentence here, if you own an asset for less than 12 months, so that's less than a year, you have to pay 100% of capital gains on your income rate. What that means is that that will be included as an additional wage effectively. This money that you make on your shares from buying and selling, you will have to pay full tax on that. But if you hold it for more than 12 months, you will pay 50% of the capital gain. So what that means is that you are paying less tax for holding it longer, holding it for more than 12 months, so you don't lose as much of your gains in tax. Because remember, the tax man is always looking. So with that said, I've talked about a lot here, but as you can see, I've discussed different options for you. As people like to buy the shares for the companies they're interested in, for example, we might look at Wesfarmers, as I showed, which has a relatively okay dividend, but we're seeing that slow growth. They're known as a boring company. They're not really doing anything too exciting. You're seeing that slow but sure growth over time. But growth investing, they're usually the fun ones. They're the ones that people really want to buy in at low and sell high. And so they're usually tech stocks. They're the exciting stocks. So that's why it's important to always be careful on the excitement of the growth stocks and try and keep level head about it and think long term. So with that said, we'll leave it there. Make sure you leave in the comments what your type of investing is and the reasons why you pick it. I'd love to have a conversation and see what you're interested in. And make sure you subscribe and like to this channel. It's a new channel. If it's been helpful, make sure you like, subscribe, share it with your friends. And I'll see you in the next one. See you later.